Okay, good morning, ladies and gentlemen, and welcome to MacroAce with your host, Tony. Hopefully if you did join me yesterday for the FMC rate decision, hopefully you found it useful, and hopefully you find this useful today as well with the Bank of England. So we have about 28 minutes till we get the rates. Now, we had a surprise this morning from the S&B, with them being the first advanced economy to cut their interest rates by 25 base points to 1.75%. So the bets had also increased for the Bank of England too, to cut more rates, to cut by more this year. But we'll see what the expectation is after the rate decision. If they do decide to continue holding where they are, which would still kind of make sense with where inflation is. So probably not really expecting the surprise element of a rate cut to occur. But let's get into it with the expectations then, and what it's all about, and what we need to be careful of. Okay, so it is the rate that banks pay interest to, the central bank pays interest to commercial banks. And why is it important? Well, the key thing is higher rates leads to slower growth, or to try and slow down growth and make sure it doesn't get out of hand. And then lower rates are done to support or create growth instead. And usually, as per normal, it will not only affect banks, other commercial banks, but it also affects how banks hand out loans, mortgages, and credit as well. Where is the economy at the moment? So this is why we'll go through the little dots here and there, particularly with inflation, and as to why a 25 basis point cut isn't really going to happen. So unemployment rate was at 3.9% compared to 3.8. Unemployment change at 16.8k compared to 14.1k. So not too much of a difference there with the unemployment data. Average weekly earnings ticked down very nicely to 5.8% compared to 6.7%, and that's also one of the key things that the Bank of England looks at is the wage prices, and if there is hotter than expected data, then that could then solidify them maybe holding on to rates for longer rather than cutting rates sooner. Inflation also ticked down nicely to 3.4% compared to 4%. Core data, same thing, 4.5% compared to 5.1%, ticking down nicely. GDP for the fourth quarter minus 0.3% compared to minus 0.1%. Year on year minus 0.2% compared to 0.3%. So technical recession is what the UK is currently in, and hence you have some speakers such as Bank of England's Dingerer saying that the effects of interest rates is already affecting the economy. Hence, she's been voting for a rate cut in the past two rate decisions. So this is something that, okay, it's not a surprise that's happened with how high rates are in such a short amount of time, but there are other elements that we do need to be careful of, such as letting inflation get out of hand. So you kind of is just going to happen to bring inflation down with high rates, that you're going to get some form of a recession, whether it be light or a deep one if things go really bad. Then carry on. GDP estimate month for month is 0.2% compared to minus 0.1%. Services PMI, which we had this morning at 53.4 compared to 53.8. Manufacturing PMI 49.9 compared to 49.2. Retail sales at 0.7%, better than the prior of minus 2.4, as was the month-on-month at 3.4% compared to minus 3.2. So overall, let's say the landscape of the UK at the moment, it doesn't look it's not inspiring, really. Gosh, just insult your own country. Great. But it's not really, there's nothing really inspiring. There's still, inflation is, I mean, we're headed towards a 2% goal. And it has taken maybe a little bit longer compared to other advanced economies, but it will probably start heating up again, become more interesting when, of course, when the central bank starts cutting the interest rates. Then, when the UK election happens, which is supposed to happen in October this year, or maybe delayed to later, but latest January 2025. But that would also help to help to change the landscape if it goes towards a Labour government, or if more or less stays the same. But yeah, so nothing really that stands out other than to the central bank. They see that inflation is continuing to decline, so you'd expect comments of the inflation process, the disinflation process that is working and is headed towards the central bank's goal, as in comments from the Bank of England, which would provide some dovish bias to the rate statement that comes through, and also provide maybe a little bit of bearish momentum to the to sterling. But if it is more or less expected, then you're probably not going to get that much out of it, unless they say that they're still not confident. Unless they're still not confident of inflation headed towards a 2% target, that they need to be more confident, and they repeat the rhetoric like the Fed have done, then you might get some bullish upside movement to sterling if they were to kind of go with that rhetoric, potentially. But overall, you may be just looking at comments of where they might see inflation. If they continue that'll be the key difference. Are they confident with inflation, or are they not confident with inflation? Do they follow the Bank of England's apparently we've got some workers around here somewhere in our walls. Don't know where, but somebody's got a drill bit. They're screwing something. Of course, bro. It's the UK. You're allowed to make fun of it. Crackheads at 3 a.m. and getting G checked. Yeah. All right. Hopefully you guys can't hear that in the background. I'm sorry if you are hearing that. I wasn't expecting anyone to come in today to do that. Anyway, let's look at the past Bank of England rate decision. Now, you can hear it. Oh no. Well, that's probably what Bank of England's Governor Bailey is hearing and feeling at the current time. So, anyway, now the previous meeting to the prior meeting, so back in December on the 14th, the Bank of England didn't offer any pivot from its normal hawkish rhetoric like the Fed did. You had Green, Haskell, and Mann that voted to raise rates by 0.25 percentage points. They see inflation just under 4.5% by the end of 2023, and around 4.75% in January, and close to 4% in February. Measures of inflation persistence are higher in the UK than other major advanced economies, and the majority of MPC members say it's too early to conclude services inflation or pay growth is firmly on a downward path. Now, the current latest statement from the Bank of England, there has been a shift up in their inflation expectations for 2 years, for 2 year and 1 year ahead. So for the 2 year ahead, they see it at 2.3% compared to the November forecast of 1.9%. And for the 1 year ahead at 2.8%, so a bit of a decline compared to the November forecast of 3.1%. Bailey said there is more evidence is needed more evidence is needed that CPI will fall all the way to 2% and stay there before cutting rates. And that's what led to the pound strengthening off of the back of that comment there from Bank of England's Governor Bailey. The rest wasn't really, there wasn't really too much. The other point being is you had Haskell and Mann that continued to vote for a rate hike. So you had Bailey, which is the main comment that caused them that caused sterling, the pound, to strengthen. Then to back up some of that momentum, you had Haskell and Mann that had decided to, or had voted for a raise in the interest rate by 0.25 percentage points. So that's what we need to focus on. Does Bailey or does the Bank of England stick with that same rhetoric that they need more evidence that inflation will fall all the way to 2%, considering how inflation was yesterday in the UK, that it did see some nice disinflation there. If they still stick with that rhetoric, as said, that could provide some upside momentum or some bullish momentum to sterling. The Bank of England is still not ready yet. If they were to say that, inflation, that they notice inflation is working its way towards 2%, but they need a bit more time, then it's just a slight difference, right, in the rhetoric. One is saying that they need more evidence that if CPI will fall all the way to 2%. The other could be saying, or what they could say is that inflation is seen headed towards the 2%, but they need more confidence. So it's already happening, and we're not sure yet. Or should I say, it's already happening, but we're not entirely confident. And the other one is saying, no, we're not entirely confident. Is that difference? And it could be the make or break between whether the pound declines or goes up, or sees a bullish momentum or sees a bearish reaction. But that's very picky. Anyway, so let's carry on. So this is the last. If we look at the Bank of England doves and hawks, you had Dingra that was on the hawk at the dovish side, Mann and Green, with Haskell still on the pendulum for the hawkish or the tightening side, tightening bias. This is the current sitting of where economists see the different MPC members. So Swati Dingra going more towards the dovish side, but you can see that there has been a little bit of a change between Pill and Broadbent. So then the question then comes into play as to who or whom is going to join the side of Dingra. To be honest, at the moment, it doesn't look like anyone is. And instead, you may get the scenario where Dingra votes for a cut and everyone else votes for no change. Maybe Dingra votes for a cut. Majority of members look for no change, and Catherine Mann is still the one looking to hike interest rates. That could be the scenario. So we also have to be aware of the votes that are presented to the markets, because that could also sway how the pound moves. So if you do get, let's say, another member that joins Dingra in voting for a rate cut, and everyone else votes for no change, then that could provide a bearish reaction to the pound. Flip it the other way, and if you get Dingra somewhere that she's kind of pulled something, or pulled some information that she's looked at and decided that she's actually going to vote for no change, that will then, you're removing the dovish bias, or the heavy dovish bias, and that could then lead to a bullish reaction to the pound, or aid the pound in its bullish reaction, or give it some support instead, depending on what's said in the rate statement. But if that were to occur, that would be an interesting surprise. If Dingra has been very very staunch in her dovish staunch stance. So that's one thing to kind of look out for. Then is, does Dingra continue to stay where she is? To if you want to see a strong market reaction, these are the scenarios that I'm kind of going through, right? Of what to expect from the Bank of England and the different members. So Dingra, if she flips the switch and goes to a hold, okay, that's a surprise. If you have another member that joins Dingra for a vote cut, not too much of a surprise, but it's still, considering where everyone is at the moment, it could still be a surprise. A little bit of surprise. And on the flip side, if you have more members that look for a vote hike, considering that you have this disinflation process that does seem to be working. Yeah, with Bailey, he's kind of, his hands are kind of tied, right? You have forget inflation too, right? You also have the effects of Brexit and how the economy has been performing. That he doesn't really have too much leeway, so he has to kind of remain neutral in his stance. Hence, when he does do his press conferences or when he provides his comments, it's very vague. But that's with more vague compared to Powell in regards to monetary policy. Because, yeah, we ain't having a party here, baby. So, anyway, let's carry on. So, Bailey and other central bank member comments said, Bank of England's man has said that on March 11th that we have a long way to go for inflation pressures to be consistent with our 2% target. Pill said that I expect inflation to fall below 2% in the spring. Dingra said that the outlook for headline inflation appears bumpy but downwards, and there are significant downside risks to the UK economy and are exacerbated by tight monetary policy. White Eagle FX will go through the deviations and what I'll be looking at. Bailey said that concerns about the embedding of second round effects have reduced. And then also from Bailey on February 20th, probably more or less going to be quite old now, but they said that latest inflation data shows more downward pressure than we expected. This week's data does not really change our view of February policy decision, cutting rates possible before inflation hits target. So at that point there, cutting rates is possible before inflation hits target. If that's brought up in the statement, that's not going to be a surprise, but it could aid bets that the central bank may not cut rates in August, but could cut rates in June, like all the other central banks are expected to do, unless you're the S&B and you've done it today. But that's something just to be aware of. So the comments that these guys make, it's hard to kind of put together and create an image or create a scenario on the bullish side for sterling and the bearish side for sterling. But that'd be a key comment to look out for: is cutting rates is possible before inflation hits target. Again, it won't be too much of a surprise, as already been said before, but it could be an element that does provide some support then to sterling in the end. So investment bank market views, RBC on the 15th of March, they said that the latest MPC meeting featured significant changes to its guidance, even though the MPC will have to soften its messaging as the point where it begins to deliver an expected first rate cut nears. And we don't think enough has changed since the last forecast round for that to begin now. So they see one vote for a cut from Dingra, 6 for no change, and 2 votes for a hike. That's Haskell and Mann for this meeting. Goldman Sachs on the 18th of March. So they continue to see rate cutting cycle start in June. They see 5 rate cuts compared to the market's 3 rate cuts scenario. They add that the meeting is unlikely to host meaningful changes to the bank's stance on appropriate path of policy, but mostly we expect it to reinforce that the Bank of England policy is not the primary reason for their more constructive view on the pound. And then finally, JP Morgan, they say they're barring a large surprise in the upcoming February CPI report. They don't expect recent developments have shifted the debate much further at next week's MPC meeting. They say that the Bank of England is set to stay on hold, and they look for an unchanged guidance and minimal changes in the vote. And they continue to see the UK as the last major central bank to cut, starting in August. Okay, so the majority then of investment banks are not looking for any major surprises, and also with how inflation has continued to edge down, then the potential then for maybe a June rate cut starts to rise. But let's look at the market pricing then. So post the Bank of England rate decision on February 1st. UK money markets slightly trimmed bets on the Bank of England rate cuts. They priced in 107 basis points in 2024, for 111 before the Bank of England statement. Money markets priced in around 50% chance of a Bank of England rate cut in May, from 64% before the Bank of England rate. February 13th, post the UK jobs data and average weekly earnings that was stronger than expected compared to the forecast. Traders paired their wages on Bank of England rate cuts this year after the jobs data. The 15th of Feb, traders added bets to after the UK GDP. They see 78 basis points of cuts this year. After retail sales data on the 16th, they saw 71 basis points. March 20th, traders add to Bank of England rate cut bets after slower than forecast CPI. And today, traders increased their rate cut bets before Bank of England, pricing in 75 basis points in 2024. So not much has changed, other than a lot has. The difference you do have a difference between post the rate decision going from 107 basis points, or let's say 100 basis points of rate cuts, to now 75 basis points of rate cuts. But in between that time, there hasn't been too much change in rate cut expectations. So it is a little bit boring in the way that the markets have been pricing in the central bank, because they're not really expecting a lot from the central bank at this point, because there's still that work to do to get inflation down to the 2% goal. And yesterday has helped that narrative. Does the Bank of England pick up on that? Probably will do. If they don't, then something has gone amiss, or they're worried about something else. Okay, so remember last time I didn't get to cover the Bank of England rate decision, but let's go through some of the other things that I wanted to go through. Let's go through the deviations, okay? If you're unsure of what the deviations are, this basically shows you how the markets have reacted to economic releases in the past, going from the initial reaction to on the 1 minute candle, 10 minutes after the release has occurred, and then 30 minutes after the release has occurred. And that's all in one place here on the deviation ranges Google Sheet. So with the ranges deviation sheet, if we're looking at the Bank of England, so with central banks, not only do I provide the movement that has occurred in different assets or currency pairs or futures, but also provide the sentiment of what had occurred and what would have led to that market reaction, or the sentiment for that market reaction. So here last time around with the Bank of England, Money markets priced in around 50% chance of Bank of England rate cuts in May from 64% before the Bank of England. Bailey said they need more evidence that CPI will fall all the way to 2% and stay there before cutting rates. Now, that was a more hawkish than expected central bank, but the market reaction wasn't as big as it was compared to others before. As you can see back in December, in regards to the when they were talking about services inflation and it being too early to conclude that it's on a downward trend. Still a decent market reaction though. So the biggest market reaction which we've seen came, so White Eagle FX, if you're looking, or if you have access to it, you should be able to see it. And it'll kind of make it a bit clear as to what I'll be looking at mainly. So you have GBP JPY. Okay, that's seen the strongest market reaction out of everyone else, and it's been consistently seeing the strongest market reaction. With the Fed rate decision, when we had seen, again, the yen still provide, the dollar yen still provide the strongest market reaction. They are, as I said yesterday, with the Bank of Japan, have already raised interest rates, come out of negative territory. So now there's a switching of places. Japan is looking to hike and tighten, whereas the rest of the world is, rest of the advanced economy is looking to slow down and start cutting interest rates. So the volatility is still there between the yen and other currencies, but we're now on the opposite side. So the yen still sees the strongest market reaction because of that reason of the difference in monetary policy, complete difference of where central banks are. Okay, and of course they've come out of their negative rate or policy for years. It's taken them years to do that. So again, it's okay. We got 1 minute left, so we will trade. So yeah, as said, GP JPY biggest market reaction, and then GBP, GP NZD, and Aussie dollar. Okay, let's get out of here. So we've got GP JPY there. Let's kind of see what the Bank of England say, if they make any surprises. Let me get TICKSTRIKE up and ready. Thanks for that little reminder. Okay, 10 seconds. I'm going to go quiet now. Okay. So no trade taken. The reason being because it's more or less the same. All right, you did have the move away from the for the vote to cut rates from man, jumping onto the no change side. But to be honest, there isn't anything else that has been said that's new. They did say what would have helped cause them the initial move downside was that further encouraging signs that inflation is coming down. But they're not yet at the point to cut rates. So that's what would have tempered this market reaction. Let's see what else they say. Policy could remain restrictive even if rates are cut. Talking about GDP and spring budget measures likely to increase GDP by 0.25% over the coming years and push up inflation by less. Services inflation remains elevated but is expected to fall back gradually. It's a little bit slow here. Okay, TICKSTRIKE still showing some of that selling momentum. There isn't really a lot to work with, other than they are seeing inflation headed towards the 2% goal. What else we got? Yeah, there's not too much going on. Okay. John Pontillo says, someone please tell Amar to list who the casters are on the live news casts so we can tip them via PayPal or Venmo. I mean, if you want to, that's it's like getting a tip for we're your waiters and we're your waiters here. So if you give us a tip, no, yeah. I don't know what to feel about that, but yeah, I'll put it to him. Let's do that. I'll put it to him and see what he says. Yeah, just give it to Just he'll deal with the tips, and we'll pay everyone else. Don't worry about it. Don't worry about it. Everyone gets a little bit of a piece of the pie. The overnight guy is awesome too. You do realize that's yeah yeah that's yeah, it's pretty cool. It is. All right. Did anyone do anything? Oh, overnight for you in the US. Wait, who do you mean overnight in the US? So of course the US session goes from 1 p.m. to 5 p.m. Eastern. Sorry, 1 p.m. Sorry, from 8 a.m. Why am I saying that? I was going UK time. 8 a.m. Eastern time till 5 p.m. Eastern time. I'm not sure. Yeah. I think you might be talking towards the tail end of the US. From 1 a.m. Oh, Ben. You're talking about Ben. Yeah. Ben and Thaddeus, who we have. Yeah. Ben and Thaddeus. Those are the dudes. Yeah. I'll let them know. I'll tell them. I'll tell them how good of a job they're doing. Says got some buys on GJ, but it's still, yeah, that's why I didn't want to jump in. I mean, he kind of is. It is just the initial move, but now it's just kind of slow going. Okay, we'll have a little think. That With that I appreciate. Yeah, that's okay. It's the first time that's been proposed to to me or to us, or maybe just to me. But yeah, we'll have a little think. You've got the pro version of FinancialJuice, right? You do realize you don't have to do that. I mean, of course, you wouldn't know that. Sorry. But yeah, if you yeah, we'll have a little think. Evangelos bought GU. Okay, all right, fair enough. Fair enough. I can't say anything. I won't say anything. I'll let it be. I'll speak to Ma. Thank you for your input, John. Yeah, that sounds great. For sure, Raja says was short GPJPY from early in the morning. Okay, so you just had a nice little extra bit that kind of helped you. Good. All right. No problem. I love Ben. Never knew his name. Well, now you do. So I'll let him know. Okay, so that more or less. So let's go through a TICKSTRIKE and FinancialJuice. Yeah, we'll go through. I wonder if I should still have my. Oh no! Well, this is bad. I don't have my unusual activity. Oh no, I do. I do have it here. But yeah, so with FinancialJuice, we have your live voice and text service all in one place, keeping you up to date with what's going on within the markets. And if there are surprises, like with the S&B, with the Swiss interest rate decision, where they decided to cut rates by 25 basis points, then keeping you up to date with that all live and in real time, so then you can make your own the best informed decision with live voice and text, providing you global macro news of what's going on around the world and in the markets, all in one place on our news feed here. Okay, so money markets pricing in 75 basis points of rate cuts by the year end, from around 70 basis points before the Bank of England statement. Okay. But yes, so you have your live voice feed here on the right hand side, which you hopefully can see me kind of scrolling at the bar there. And on the left hand side, you have your economic calendar of the upcoming economic releases for the day, and also for the week ahead as well. Luckily, tomorrow it's going to be quiet. So from the busy week with the Fed interest rate decision and the other interest rate decisions that have occurred, and then here, as you can see here in the center, you have your text headlines that are that come through. Also, the data charted as well. So that's FinancialJuice. Now we currently have an offer at the moment for a 92% discount on our yearly subscription. So instead of paying $1,000 or $1,100 for a year's worth of a year's subscription, you get 92% off with our March Madness promo code, and you can get FJ for $99 instead. So from $1,100, knock off about 92%, and you get $99 for the year. So this is the link to that there, which you can have a little look at. Yeah, it is insane. So and yeah, thank you for the little help in the advertisement there too. But yeah, it is insane, right? Instead of paying, as I said, instead of paying $1,100, you're paying $99 with a 92% discount for the year. So that's the link to that there. This is the promo code. Now, before we go and jump on and then select your subscription, no matter what it be, if it were to be the yearly, make sure that you have a FinancialJuice account. Okay, with and that will take you to the that'll be the light version of FinancialJuice. Okay, the light version of FinancialJuice, it does have a delay across the website, across the newsfeed, across the site, but it's still useful to have a look at. But make sure you do have an account on FinancialJuice, and it will be on the FJ Lite version. The reason why I say that is because once you've got your login details, and if you don't have your login details, and you then subscribe or pay for the pro version of the service, and there's nothing for you to log in with, then it makes it harder to kind of fix that issue. So create an account first on the light version, then make sure you verified your account from your email. Once you've done that, then you can, as I said, you can use the link there that says that's been provided. So let me pin that here. Okay, that's pinned there. You can use that link that's provided, and then select your subscription, and also you have the promo code as well to use. Then once you've done that, log out of FinancialJuice and then log back in, and then you'll see the pro version of FinancialJuice as I see it here. Okay, so that is FinancialJuice. Now TICKSTRIKE, of course, it's a bit quiet today with the Bank of England. Not much really happened. But TICKSTRIKE, what does it do? Well, TICKSTRIKE allows you to be able to see the strength of the buying or selling momentum within the markets, within different assets in Forex, crypto, stock futures, in futures in general, most futures, ETFs and ETNs, and internals like the ADD or the VIX. Okay, all in one place with TICKSTRIKE. So again, I'll say that TICKSTRIKE allows you to see how strong the buying or selling momentum is within any asset class, well, the majority of the assets that we have available to us, and that is shown through what we call the ticker box. Okay, or the ticker here, right? This little box. This shows you the strength of the buying or selling momentum. Now, this has a little slider here, okay? And what this number represents is the sensitivity of that ticker. So 1 is the most sensitive to market reactions, i.e. when there's a little bit of buying or selling that goes on, then TICKSTRIKE will, as you can see there, GPJPY, will give you a visual and audio alert, okay? Or you can just decide to do visual or audio, whichever way, but it gives you a visual and audio alert as to the buying and selling strength of that asset that you're looking at. Now, the other cool thing about this is that you can adjust the level of sensitivity. So you can adjust how many times or how often TICKSTRIKE will give you an alert. The higher you go, the less alerts you're likely to get, okay? Because you're increasing you're decreasing the sensitivity. The 15 is the least sensitive to market reactions. So only when there is a big amount of buying or selling that occurs will TICKSTRIKE give you a visual and audio alert. Okay, so if you're day trading, it's a perfect tool. And like with today, I was keeping an eye on TICKSTRIKE, and you can see it's dead. So there isn't that much to kind of play around with. So that's it. But as said, so that's what TICKSTRIKE is there for. Now there is one more thing. been keeping. Love TICKSTRIKE. Still haven't mastered it yet. So yeah, I mean, take your time with it. So key thing is with TICKSTRIKE, you can use it to manage your risk, see if there are any potential opportunities with the markets, or do whatever you want to do with it. Okay. Yesterday with the FOMC, when you'll probably see in the video, the live stream yesterday, when traders were pricing in an additional amount of easing from the Fed, I bought up on the S&P 500, and the TICKSTRIKE and the momentum for the S&P from TICKSTRIKE was kind of showing that there was enough strength for it to go up a little bit, and then I exited the trade from that. So there's that too. Of course it's going to be difficult, but have a little play with it. Van Ripper, there should be a morning juice. Do you not see it? Oh, that's a good point. I'll let the boys know. Hold on, give me a second. Yeah, they're on it. Don't worry about it. So yeah, apologies for the lateness of it going out, but it is going out. So yeah, one final feature of TICKSTRIKE is you have this lightning bolt symbol. So this lightning bolt will make TICKSTRIKE uber sensitive to market reactions. So if you thought one was most sensitive, you're wrong. So if I click that here, this goes 15 levels below 1. So then if one is the most sensitive and it's 15 levels below that, as said, it is uber sensitive to market reactions. And you'll see in a second why. You can see all the little bits of buying or selling that occurs with this here. So if you're scalping the markets, then this part of the tool makes more sense. Of using the lightning bolt, version of TICKSTRIKE. Of course, do whatever you want to do, whatever works for you. And the same thing, you can adjust the level of the strength. Remember, it's 15. So you're going 15 levels below 1. So you can adjust the level of the strength to whatever suits you, whatever works for you. But that is the lightning bolt version of TICKSTRIKE that is available to you guys there. Now, I'll put that in the chat here. Yeah, let's see. There we go. Okay, so yeah, as said, it's representing the volume of the strength of buying or selling momentum that is occurring within the market there, or within the asset. Alrighty, so hold on, give me 1 second. I'm just trying to find something. Okay. I haven't used unusual activity in a long while, and it's doing its updates, and that's going to take a while. But so final thing that I want to kind of go through is with a final thing that I want to go through is just with well, all right, we'll have to leave that for later. We'll have to leave that for another time. But as I was saying, so if you want to get your hands on the deviations Google Sheet, then all you got to do is sign up to the MacroAce mailing list to get your hands on that. And I'll also be sending an email on, there we go, there's a link there. I'll be sending an email on Monday morning for the upcoming economic releases, which there won't be any, but I'll double check anyway for next week. You'll get a week ahead of what to expect in the Europe and Asia session, in the US session as well, and then you'll be you get the links to the deviations and ranges as well. Okay. What I'm going to show you is an example of an email that is sent out. Okay. So this was, as I said, this is when I put out the CPI data. When we had the CPI data back then. Here, as I said, it's quite short. There's not too much detail that's kind of provided because I go through that detail in the streams for the economic releases. But as I said, there is little bits here and there from different investment banks and their thoughts and views on what the central bank is doing. Okay, or excuse me, not what the central bank is doing, or what the central banks could be doing if an upcoming rate decision is coming around the corner, or is going to happen that week, and in general with economic releases or any other things that traders need to be aware of for the week ahead. Okay, and then a summary of the week ahead, a summary of the weekend news if there has been any, or the news so far. As I said, the deviations and ranges link is there. A link for the live stream is also there too. So it's quite short, just to kind of temper your expectations if you're thinking of seeing big charts or a load of charts or graphs and in-depth detail. It's short. It's supposed to act as a refresher. So take it as you will. But yeah, so sign up to that mailing list and then you get access to the deviations and ranges sheet. Okay. All right. I will see you guys. Well, that's it. That's MacroAce for the week. Have a great weekend. And I will see you guys next week. Don't forget to like the video, subscribe to the channel, and get the word out there. Okay. All right. Sayonara, everyone. Take care.